Hi, my name is Travis Pearson. I'm with CMR Risk and Insurance Services, and I head up our team's surety practice group. We have a program for low-income housing tax credit recapture bonds that we receive a lot of questions on. So we decided to make this short video on a Q&A about the most common questions we receive. The two most common questions we receive are, one, how much do they cost? And two, have you ever had any claims? However, I'm going to save those questions towards the end. Therefore, you'll have to stay tuned for a little longer to get the answer to those. One of the more common questions we receive is, I thought recapture bonds were no longer needed. While that is correct, the IRS no longer requires a recapture bonds in the event of disposition. There are many investors out there that won't dispose of their ownership within the 15-year recapture compliance period without some type of collateral. Oftentimes that collateral can be a letter of credit or cash. However, most investors will accept a recapture bond in lieu of a letter of credit or cash. Another question we often get is, what is a recapture bond? So a recapture bond is really a performance bond guaranteeing what's in the underlying purchase and sale or partnership assumption agreement that states that the buyer is going to continue to operate the property in compliance and pay any tax credit recapture if they do not. So the bond, again, is a performance bond that guarantees that underlying agreement. Back to the most common question, or one of them, is how much do they cost? So the recapture bond pricing is really based on the time left of the compliance period. Our program's rates are 0.625% per year left in the compliance period, subject to a minimum rate of 1.25%. So anything with 2 years or less left in the compliance period is a rate of 1.25%. That rate is applied to the bond limit, and the bond limit is the recapture and interest exposure estimated the year of the transaction date. So in order to determine the price, really the very first thing you need is a recapture analysis. And our office can put those together with copies of the 8609s or a credit flow schedule that shows the amount of credits claimed per year. But depending on the size of the project and what year the compliance period you're in will greatly affect the bond limit, which the rate then gets applied to. One of the more common questions we get is a recapture bond insurance. It is insurance, but really only for the seller. So the buyer is obtaining the bond, but it's just guaranteeing the performance of what's in that purchase and sale or partnership assumption agreement. So the bond is just insurance for the seller, or really the initial entity that took the tax credit benefit. And along those same lines, because it is a performance bond, the surety company does obtain indemnity from the buyer. A common question is, okay, who does the surety company require an indemnity from? And that really depends on the structure of the buying group. So if the surety company is okay with entity-only indemnity, however, there has to be an entity that's widely owned and owns a wide range of assets. So really a true going concern entity. If an entity like that doesn't exist and there's only single purpose entities that flow down to an individual, the surety company does require indemnity from that individual in a review of personal financial statements. Another common question we get is, are there any costs or fees with regards to underwriting? No, there's not. So we, again, perform recapture analysis to help determine premium costs and all of our underwriting process to get groups approved. There's no underwriting fee or application fee or anything along those lines. The only cost is the cost of the recapture bond, and that is a transactional cost. It's a one-time premium, and the bond's in effect for the remainder of the compliance period and any audit discovery period. There's no renewals or no request for additional information. It's one-time underwriting process, a one-time fee, and for the bond itself. And therefore, if the transaction doesn't close, there are no costs. So there's no other underwriting or fees involved. The second most common question is, have we ever had any claims? Yes, we have. So as most people are aware, a lot of these low-income housing tax credit projects have thin cash flows. Therefore, foreclosure is a real risk, and we have had a couple claims dealing with foreclosure. The other main claim area is a casualty loss. So while casualty in itself doesn't lead to recapture, as long as you rebuild within a reasonable period of time, it will lead to recapture if you're unable to build to the same size. So if there's a setback and say you're only allowed to build 2 stories versus 4 stories, or you need a 40-foot setback versus a 20-foot setback and can't rebuild, that'll trigger recapture. Or if you have an earthquake or hurricane, those types of insurance often come with larger deductibles, as high as 10% of the construction value. And sometimes it just doesn't make sense to come out of pocket 10% of reconstruction costs on a project that has a very thin cash flow margin. So those are the most common questions we receive with regards to low-income housing tax credit recapture bonds. If you do have any further questions or have any other deal-specific items you want to discuss, please feel free to reach out to us. Thank you.